There are certain names in the world of finance that once they appear, the entire market falls silent. Michael Burry is one of them. He foresaw the 2008 crisis before anyone else. And today, once again, everyone has started paying close attention to what he says. Moreover, this is a serious advantage for the investors who have been following him for years. Every note Burry shares, every position he takes, every macro comment he posts serves as a lesson in itself. No one can be 100% right in finance. Not Burry, not anyone else. But never underestimate what you can learn from old wolves who have spent their lives on Wall Street. Michael Burry is an investor with a medical background. While studying medicine at Stanford, he took his first step into the world of finance by writing investment analyses, and he quickly became a phenomenon. His analyses on forums were so good that even some major fund managers started following Burry's posts. In 2000, he founded Scion Capital. Starting with roughly $40 million, the fund proved itself quickly with the high returns it generated. Especially during the 2001 to 2003 dot-com collapse, his ability to generate positive returns made Burry even more famous. Burry realized that the mortgage market was going to collapse almost 3 years in advance. When he studied subprime mortgage loans, he saw that the system was rotten at its core. Banks were selling these products to one another, creating new derivative products on top of them, yet ignoring everything about their risks. And Burry used a tool that almost no one even knew about at the time: CDS, Credit Default Swap. This remains, even today, in textbooks as a rare example of financial ingenuity. Burry's short positions have always been a topic of debate, because people tend to perceive short equals being hostile to the market. But a short position is not a single, simple transaction, and under no circumstances is it held for years. Shorting is a tool used by a portfolio manager to reduce risk and protect gains. Without this tool, portfolio management eventually hits a wall. The biggest mistake made by those who don't understand finance is treating shorting as if it signals the end of the world. Taking a short position does not mean waiting for an asset to go to zero. Even if it goes to zero, the maximum profit is already 100%. If an asset drops 100%, it is technically gone, so the position is closed long before that. Recently, Burry again made headlines with the small hedge positions he took against certain tech giants. For example, Nvidia and Palantir. People online joked, saying Burry was wrong, his position collapsed. But here is the truth. The size of his position wasn't even 1% of his entire portfolio, and both of these companies fell 35% from their peaks, so the position did its job. In American indices, the largest declines during major historical crises are in the 45 to 50% range. Even at those levels, prices don't stay down for more than 1 to 2 days. That was the case in 1929, and it was the case in 2008. So, in most cases, the drop you will actually observe is 20 to 30%. Those imagined 90% crashes are extremely rare in the real world. This is why what Burry does is simply rational risk management. People who say Burry was wrong with populist arguments do not truly understand the dynamics of financial markets. Burry is a fundamental analyst. He looks at data, not price. He doesn't follow trends. He never invests emotionally. One of Burry's famous sayings is, "The most dangerous thing in markets is when everyone runs in the same direction. His success lies exactly here. He follows data, not the herd. Because even today, the market is going through one of the most complex macro periods since 2008. Massive liquidity injections, astronomical valuations of tech stocks, geopolitical fragility, inflation cycles. If you take finance seriously, you must listen to investors like Burry. These people have the capacity, the experience of observing markets from the inside for years and an understanding of behavioral finance. You don't have to follow Burry, but there is a lot you can learn from him. And especially in periods like this, someone like Burry, data-driven, radical, and willing to take positions opposite the crowd when necessary, teaches the market a lesson. Michael Burry is not a prophet. He makes mistakes too, just like all of us. But watching an investor who has changed market history, trying to understand how he thinks, this is an extraordinary advantage for understanding financial markets. This week, the Fed cut interest rates, but the statement that accompanied it gave mixed signals about the future. To understand what might be happening behind the scenes, we need people like this. If you enjoyed this video, don't forget to hit the like button and subscribe for new content. We will continue exploring the fascinating events and figures of financial history together.